Welcome back to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the Daily Stock Analysis and editor of the IBD Extra newsletter.
Well, we want to welcome IBD Chairman and Founder Bill O'Neil to our special 100th anniversary show. And Bill, you know how thrilled we are to have you on the show, and I'm not going to embarrass you with all kinds of accolades of how wonderful you are, because all of our listeners know how great you are. But anyway, thank you so much for joining us.
Well, you're very kind.
So in this segment, Bill, we want to talk about how you got started, your beginnings. And part of that, I'm sure, is who you were influenced by, what kind of traders influenced you. And I remember when I started at IBD, actually just before I started 10 years ago, I was given a copy of your book, How to Make Money in Stocks, and I read that, really enjoyed it, was very inspired by it. Then I read the book about Jesse Livermore, Reminiscences of a Stock Operator, and I could see several CanSlim concepts come to life. So I wonder, what traders or books influenced you when you were getting started?
Well, the first person that I can recall was Gerald Loeb, and he had written The Battle for Investment Survival, and he was market-oriented. He was a tape reader, really. And he came out of San Francisco, and he spent most of his time in New York. But I actually met him there, and we had a long conversation. He came down to L.A. one time, and we met. So the ones that I was always impressed with, I would somehow see if I could get to meet with him and just talk to him about things. And he was the first one. Now, the person that had an enormous reputation over the years, but it took some time for everybody to understand that, was Jesse Livermore. In other words, he was a really unique trader that made millions and lost millions. And the stories are great, and his book was very valuable. And so it started there. And then you just look periodically for anything that's worthwhile. The one thing I did learn is there are only about 5, 6, maybe 7 books that are really worth reading. But every professor in the country has written a book, and a lot of other people. So you want to find a book from somebody that you know has really done well. And there are some out there, and you want to read 2 or 3 of them.
You know, Bill, these are, and I've read all these books too. There's Jesse Livermore, Bernard Baruch, Gerald Loeb, Nicholas Darvis. What do you think? Now, obviously, they all had different personalities. Was there something as you studied them, you met them, got to know some of them, that they all had in common that you said this is what makes, a really great trader?
Well, I didn't meet all of them.
Not all of them, I know.
But I think that there's a certain amount of humility because you have to make enough mistakes and learn how to overcome them and not be thrown by them. They're usually people that are market-oriented. It's not just theory.
Mm-hmm.
They're not. I'm sure there's some good college professors out there, but they're not any ones that I really followed. These were people that were in the market. And, for example, Loeb made several $1 million when he was a young man in San Francisco pyramiding, and I don't remember the stocks now, but there were 2 or 3 stocks. So that's what I was always looking for, is who really is excelling. And the first one that I noticed was Jack Dreyfus, and it was because he had the Dreyfus Fund, and they were performing in those old days better than any of the other funds. And I'm looking at it and trying to figure out, well, now, what in the world is this guy doing that makes him able to outperform everybody else? And at one point I went back to New York, and I visited with their office, and he was a chartist, and he had a giant book. And they had a couple of young kids posting on daily charts all the things he was watching. And also he had a tape running across most of the rooms in his office, like in the accounting department or whatever. So he was solely market-oriented. So that's how I've done it, is find somebody that really is making money in the market and then figure out, well, what the heck are they doing?
Well, I remember when I interviewed you for my book, one of the things you said about Jack Dreyfus that struck me, a couple things. You told me that he was a brilliant bridge player, so he would think very deeply and strategically. It wasn't just a lightweight kind of thing. And the other thing you said is you went through his fund and you went stock by stock. You said they were all hitting new highs. And for you, wasn't that one of your epiphanies that, wow? I mean, it seemed counterintuitive to what we should be doing, and yet
That's when I realized charts are important. But it started by knowing that he was performing better, and I wanted to find out how. And I got 2 or 3 of his quarterly reports, and I plotted out charts on all these things he owned, and they all had chart patterns, and he never, ever bought anything unless it was going in new high ground, period.
Wow.
So it wasn't just a few here and there. It was very obvious after a while, this guy's a chartist.
And is that how you came up as you did your deep, deep studies that go back to 1880, that the N in CanSlim, one of the is stocks hitting new highs? That's one of the components of CanSlim.
Yeah, and that's the way it works. You have bases, and a stock emerges from it and makes a new high. And the base was formed by accumulation on the part of certain institutional investors.
That's right.
And in the old days, it was the pools that gathered together and would do the same thing. So it's always a professional group somewhere. It's not the public.
That's a fascinating thing, though. You're talking about how you went out and met Gerald Loeb and Dreyfus and others and really started to study from the best people. And then one of the things that is so great about what you've done in the decades since is you really codified that system and broke it down into the CanSlim system, the 7 traits that we're looking for. And back to this idea of epiphanies, one thing that really struck me when I was reading the book about Jesse Livermore is there's that scene where one of the old-time traders is there and people keep walking up to him and asking him for tips. And all he says is, "We're in a bull market, aren't we?" And that's all he says. They keep asking him, "Hey, we're in a bull market, aren't we?" Well, that to me was kind of an epiphany tied together with your book about how important market direction is. So at some point, that must have been a big epiphany for you, too, is just how important the overall market is to any individual stock.
You don't have to be at it very long until you realize, hey, there's a period that you're going to get hurt, and there's a period that you better understand it's changed. And but I just don't remember exactly how I came up to that. I do know that I realized that when I looked at the Dreyfus Fund, all the new positions they'd taken, that every one of them had a chart pattern, and he was a chartist. So I got the individual stock thing, and I don't know at what point that I got into that general market thing, because that's the other side that you have to have too.
Well, the thing that I think is so brilliant, and I think people do understand out there, what you've done is you really took market history, and I know you've been very modest. You've said a lot of times CanSlim system is not yours. It's just that you've studied the market so very much that this is actually how, stocks and the market really behave. But for us as individual investors, it seems to me like that's the greatest gift that you've given to us, is you made sense of this whole market when you did your studies of all these major stocks and these biggest winners.
The one thing I don't think anybody realized was that there really is nothing new in the market, and that the patterns you see today were there 20 years ago, 40 years ago, 60 years ago, 80 years ago. And it doesn't make any difference what the time was. Now, there were different people making those patterns, so there's not really that much that's new. And it was shocking to me when I went back to get old leaders, 50 years ago or 100 years ago, and plot out a chart.
Right.
And there's your cup with a handle, and there's your flat base, and they're all there. And it had been there for years.
Yeah, whether it's Tennessee Coal in the late 1800s until Apple 2004, same thing, same cup with handle.
It should tell you that, well, my gosh, this has been going on for a long time. How come more people haven't figured it out? Well, a lot of people are just a little bit too lazy, or they listen to what somebody else has to say, and you got to dig around and look, but the patterns are the same, and they haven't changed. Now, I don't know exactly why that's that way, because obviously the people buying it today are different than the ones buying it 100 years ago.
Mm-hmm.
But I guess it was a professional element, or maybe the old barons that were fighting each other back 100 years ago, and now it's mutual funds.
Sure.
Well, that's a great segue into our next segment, where we're going to talk about that really landmark benchmark study that you started many years ago and now covers the market going all the way back to 1880. So we'll take a quick break, come back and talk to Bill O'Neil more about that famous CanSlim study.
So, Bill, I know you and the portfolio managers have done studies going back to the 1880s, and you've mentioned in the previous segment that bases are the same, those haven't changed. Perhaps maybe volume has changed in the market. I know you went through this and you've studied a lot of the market's biggest winners. What are the biggest things you've learned from doing all these market studies?
Well, that's a very good question. I think the thing is that this country is a country of innovators and every cycle has new companies coming along that you never heard of a couple of years ago, and new inventions. So your job is to have a way to track these, and of course plotting charts is one way, and all of a sudden if there's this new unique thing out there, it's going to start acting better than something else and forming a pattern where there's some accumulation going on. So the accumulation occurs by professionals, mutual funds and others. It's not the public. They will know something about the company, and that's why they're buying it. And a big fund, you have to think about the math that, let's say a fund has $2 billion in it and they want to take a 3% position. Well, how much money is that? And they may be buying that stock for 6 or 8 or 10 weeks in order to get the position. And they will tend to, in a way, form these patterns, just their buying activity. So it's not the public, but it's the professionals that create all of this.
So, Bill, I know you've talked about at some of the Level 4 workshops, some of the market's biggest winners, and I've heard Scott say this, I've heard the portfolio manager say this, that you have an uncanny ability to zero in on the very best stocks. These, whether it's a game changer like LinkedIn or Tesla or whatever happens to be in the current market. Are there certain key things you look at to determine, what company is just absolutely going to knock it out of the park?
Well, after you've done enough work, it gets fairly easy because your objective is to find the stock that is the strongest stock that could potentially triple in price. Mm-hmm. So you're looking for that very thing. So charts are an easy way to look at hundreds of stocks, and I can go through a chart book and turn page after page after page of things that don't look right, and all of a sudden we'll come to one that has a pattern that looks like it's under accumulation and it's acting stronger than the others. And as soon as I see that, then I go look to find what are the earnings, how much are they up. And I don't want to buy something with earnings up 10 or 15%. I want something that's up 40%, 50%, or 100%. And the sales and these different things. So that's how it starts. You see the idea through going through hundreds of charts, really. Mm-hmm. And then you make sure that, hey, this company has a real product that's unique. You understand the story. There are big earnings there. There are big sales, and there's a good profit margin or return on equity. And you make sure all that. So it's not charts that make the stock go up. It's the big earnings and the new product.
So take us back to your own experience where, let's say in the beginning of some bull market cycle, you found one of those stocks that had the potential to be one of those very big winners in that cycle. How did you find it, and how did you know, or how did you suppose that this could be one of those big winners?
Well, you're asking a very important question, because what this is a part of is you have general market indexes, the Dow, the S&P, whatever. And you get into an intermediate correction of 8, 10, 12%, or a bear market of 9 months, you're going down, down, down. And at some point, you finally turn and come out of it. Now, that's critical to recognize rather than saying, oh, I'm bearish and the economy's bad and everything. Once that market turns and has a follow-through day, the strongest stock will probably break out on that day, or it starts moving up very rapidly and then forms a little handle and comes out a few weeks later. So the big moves make a quick move once the market is turning. So I've learned that if I have a fall-through day, I want to buy something that day. And usually it may be your best stock out there, because those ones have been suppressed by the negative market, and now you're having an up market. They come up very quick because there's somebody out there that knows what's going on, and they're buying and buying. And so in that first day or first week or two, you should have your big leaders coming out pretty quick.
Well, that's like the beginning of the bull market in 2009 in March. Green Mountain Coffee Roasters popped out real quickly. We had Netflix popping out, Baidu, and even Apple, I think 2 weeks after the follow-through day. So you're right. Those are the stocks that we all should keep an eye on.
And I can look back 10 years ago, 15 years ago, whatever, and remember that you're going through a correction in the market, and all of a sudden you get the follow-through day, and that big stock of the cycle breaks out on that day. It doesn't happen always that way, but again, you can't be having a lot of opinions. Oh, I don't think the economy's too good, or I don't believe this rally.
You have to.
You got to pay attention to what's going on and recognize, hey, this thing just broke out of a perfect pattern. and you're just turning in the market. So getting that turn in the market, it's very important for you to be objective and be looking, because the best ones will come out pretty fast.
So do you get the most excited? And I think people might find this funny that people say, oh, we're in a correction, that's bad. For you, isn't it sort of a positive thing or an exciting thing that we're going through? Let's say at some point we're correcting. You know that after that correction, you're going to get these stocks coming out of there.
Well, I don't get excited seeing the market go down. But
maybe I said that the wrong way.
But I can be very bearish, and 2 days later, I'm going to be very bullish,
right,
depending on what has occurred. So you don't want to get fixed in your opinions, because your opinions aren't worth much. So you've got to track the market. And I can shift very quickly, so I'm not going to miss a turn in a market.
I want to go back, though, for a second to, let's say you get that turn in the market, and maybe you buy 2 or 3 stocks right as that new uptrend begins. What are you looking at? I know there's a lot that goes into this, but what are you looking at to see that out of those 3 stocks, this one is probably has the potential to be that big winner, and you really want to focus on that?
That's very easy. I have certain parameters I'm looking for. I want a base pattern, and I don't want just the chart. I want the earnings to be up and the sales to be up, and understand what's the product. So you got all that to start with. Now the market will tell you. This one goes up 5% and that one goes up 10%. Well, the one going up 10% is a bigger leader than the one that went up 5%. So the market tells you out of what you've got. Invariably, I'm looking at, well, I've got 3 stocks, and this is my best one and my second best and third best. So that kind of oversimplifies it, but the market will tell you this is your best stock.
Welcome back. It's now time for part 2 of our interview with IBD founder and chairman Bill O'Neil. Bill, last week we talked about finding top stocks. So today, let's talk about how to handle them once you own them. One of the reasons you've been so successful is, more than most other people, you have the ability to sit tight and hold onto a stock that's showing the things that you're looking for. That's not easy to do when a stock is going down several percentage points and you're getting nervous about the money. How do you sit tight on those stocks that you believe have that potential to be the truly big winners?
Well, you ask an important question there, and I think that they are different. As I look back on it, and this is a good exercise for you, you should go back and look at the last 5 or 10 years, whatever, and find where did you make the most money, which stocks, and kind of rate them a little bit. So I can look back, and I do not hold a lot of stocks a long time. But if I buy a base, and it will have the earnings and sales, because I'm not going to buy it just because of the chart. It's got to have all the others. I've always liked retail stocks and drug stocks because I could understand them. I never did quite as well with high tech.
Can you give us an example?
Well, Pick and Save was one of the first stocks, and that was a retailer. It was a little dinky retailer that, in fact, when I bought my first stock, it was trading, it's unbelievable, it was only trading 500 shares a day.
Wow.
It was a dinky little thing over the counter. Nobody knew about it.
Right.
Had a perfect cup with a handle. Earnings were up. And that stock increased their earnings 35% a quarter just year after year for a long time. And it just built base after base after base. Well, I'd been in the stores and had looked at them, and I understood them. So the ones that I'm sitting with are ones that I know and feel and understand. And you can go in any retail store and see, have they got something unique, and they got a lot of cars in the parking lot, and are a lot of people buying things. And that's what happened in Price Company when the Price Club stores. I went in the first one down in San Diego, and I said, wow, this is something really unique. And there are people all over the place buying things. And now here's the interesting thing. So I studied up, and I liked the stock, but it had been going up, and it was not in a base at all. And it was in the over-the-counter market. And I bought it 3, 4, 5 months later when it finally went through a correction, built a base, and came out, and it had an 8 or 10-fold advance because they only had 2 or 3 stores when I went into one. So that's the other thing with retail that I like, is that if it's got something unique and it's working, they can open it in all these different cities.
One thing, Bill, I don't think you realize, which I think is remarkable, I just want to say thank you. Probably one of the biggest things I've learned from you, we look for all the great technical stuff, the fundamentals, the big earnings, the big sales, the return on equity, and the accumulation distribution and all that. One thing I've gotten hammered into my brain was that N in Can Slim, because I've heard you speak so many times at the level 4s and the different workshops and opening up the meetup groups with you, which was so much fun. I think people really need to listen to what you just said. These new innovative companies, when you went into Price Club, there was nothing like it. Now we have copycats. We have Sam Clubs and all the others. But at the time, that was the only, you said you saw these big crates and people would come out with like $99 worth of goods each time that they came out. Pick and Save at the time was another. That was just something brand new. So I've really got that hammered into my brain that you're looking for these really innovative.
See, you do not want a company that is a copycat,
right?
That's copying what somebody else is doing. You want somebody that comes out with something totally new, unique, and different, and superior, and either cheaper or what all. And they're there. So Pick and Save was this outfit that bought only overrun merchandise. They would bid on products that, say, a big manufacturer's got an overrun and they're not able to sell it, and they would buy it at 10 cents on the dollar, and they would put it in their store, and that's what they were doing. Everything they bought was that type of merchandise, so it was not like a normal retail store.
Right.
And if you bought something in there and came back a month later to try to buy the same thing, you probably would never find it.
Right.
Because they're buying these overruns and these things that have little problems with them or something. So they had a unique concept. And I always liked retail because you can go look at them.
Sure.
And are people buying things? And I used to count cars. When I was interested in Home Depot, I'd go by the